everyone. Thanks for tuning in to another episode of the Everyday Real Estate Investor Podcast. I'm Ben Nelson, your host, and I appreciate you listening in. It is a great day to talk about real estate because it's another day. So it's always a good day to talk about real estate and what's going on and strategies and how to meet our goals in real estate investment to help it get us where we are going in our financial life and trying to set us up for to have that life that we dream of. And real estate is an amazing tool to make that happen. And just want to continue to encourage everybody to get out there. If you're whatever you're struggling with, if it's getting your feet wet and getting in the game and making it happen that way, or just trying to figure out how to scale. Hey, let's go through those struggles together. Let's figure it out. We can get through it. We can help each other, and we can make those things happen. So don't give up. Your dream is definitely achievable. Just keep at it and you'll make it happen. So today we are going to talk about how to pick markets and what to look at and things to consider and all of those sorts of things, because it is very important to be looking at what markets make sense and what markets you want to be investing your money in, and especially as things are changing here in the market. We talked last week about how to make money in a down market. I'm not saying we're in a down market. We go back and listen to that one if you haven't listened to that, and then pay attention to my next market update video that I have coming out here soon for a little bit more on the market. But yeah, I mean, the gist of it is everything, there's national things going on. There's lots of things happening. Your headlines are all pretty much focused on a national level, and every market's a little bit different. So that's why we want to look at markets, see which ones are going to maybe struggle as the market shifts, and see which ones are poised to continue to do well. And there, you can't look at the real estate market and national numbers and say this is what's going on in every market. It's definitely not true by any means. And you can find the markets that are going to do well and make sure you avoid the markets that are not going to do well if you do a little bit of research beforehand. So, and the first part of that is really starting with, so first of all, not just necessarily investing in your backyard. Your market that you're located in may be a great market, but it may or may not fit with, it may not be poised to do well. It may not fit with what you're wanting your investing to do for you. So that's kind of the first thing to wrap your head around. Is there's nothing wrong with buying in your backyard. We buy in our local market, but we're also looking at outside markets as well, because they do different things for us within our portfolio, and there's just different opportunities in other markets. So something to consider if you haven't, looking outside. And it may be a different market in the same state. It may be a different market in a completely other side of the country. So just keep an open mind to that, and just realize that it may not be in your best interest to only buy locally in the market that you're located in. So first thing that you want to start with whenever you're looking at your real estate investing is, what are you trying to do? What are you trying to accomplish with your real estate investing? Because if you don't start there, then it doesn't make sense to buy a property, because it may or may not help you get your goal if you don't know where your goal is, right? We talk about not even just in real estate, in anything. If you don't know where you're going, you have to have a goal. You have to set a destination, because if you don't know where you're going, how are you going to get there, right? And then you're going to start making all these decisions and taking all these actions, and it may not even line up with what you want to do and what you want to have happen. So the first thing is, look at what are your goals. Are you looking at, do you want to build cash flow? Passive is maybe not the right word, unless you're truly a passive investor, maybe involved in a syndication or something like that. But if you're owning the property, yeah, mostly passive maybe, but you always have some involvement in the investment. But cash flow, are you looking for monthly cash flow? Are you looking for equity growth, something that's going to build value more quickly in an appreciating market? Are you looking for something that maybe has a little bit of both? It's probably not going to have the most cash flow. You're not going to find a market that has the most cash flow and the most equity growth. That you're going to have ones that are maybe kind of in the middle and that have a little bit of both, right? Are you looking at something short term that you're going to shift into something else down the road, or are you looking to just put your money into something and you're just going to park it there for a long time and just continue to get that cash flow and equity growth? I mean, these are all things that you need to consider when you're looking at your markets. And is it, are you looking at doing like a 2 or 3 step, and instead of just putting your money into something? Maybe there's people that a great strategy is you buy something in an equity market, you force some equity, or it gets a large amount of appreciation over time. Maybe it doesn't cash flow very well in that market, but you can build equity quickly, and then you take that equity and then you transition that and you trade that into a market that has better cash flow. But you can buy more in that market because you use a different market first to build a greater equity that you could then use and put into some more cash flow heavy properties. So that's all things to consider. And one thing that I always like to point out is you don't buy a stock, right? We're not stock investors. I have some money in the stock market, but I'm not a stock guy. I understand real estate is tangible to me. I'm not saying investing in the stock market is a bad thing. I just don't understand it enough to be effective in it, right? So, but if you are a stock person, you don't buy a stock based on, how or where the company's located, right? Oh, they're headquartered in this market over here. They you don't do it based on that. You do it based on the fundamentals, right, and how it's going to perform. And you do it based on the results that you are expecting from that stock, right? Is the stock going to grow? Is the company going to grow? Are they going to be more profitable? These are all the things you can look at. The same thing within a real estate market. You don't buy it just because it's in your backyard or in a market that you think is cool and you want to visit or whatever, or that you have family or a friend there, so they can be boots on the ground for you. If you have that stuff, that's great. If it's a market you like to visit, if you have a contact there that can help, all that is great. That's not a reason to pick the market. That's maybe a benefit if the market makes sense without that consideration. So you want to pick it based on the fundamentals, and you want the fundamentals to line up with what your goals are in your investing. So I always say, and I mentioned this time and time again, totally got this from the Real Estate Guys radio show. Those guys are awesome. I learned a ton from them, been to a lot of their events, and if you haven't listened to that podcast, it's a great one to listen to as well. But basically this is an adaptation or the gist of what they say. They talk about personal investment philosophy and what you want the real estate investing to do for you. And then they also talk about starting with, most people start with the property, right? I'm going to buy a property, and they go search for a property. Really, that's the last thing you should be looking at. You want to figure out what are your goals first. What do you want real estate investing to do for you? What's your strategy that you're going to implement? Once you figure out what your goals and what strategy is going to work to help you reach your goals, what market can deliver that result that you're after, then you build a team there, and then you start looking for a property. So you don't start with the property, you start with your goals first, and then you go from there. The property is the last thing. It's still important, but without those other steps, it's definitely less important than the other steps, because a great team and a sound strategy is going to lead you to the right properties, versus just kind of shooting at a dartboard and hoping that you hit it, right? So that's what you want to start with. Start with your goals. Start with where you want it to go. Now, when you're looking at a market, so the next step then, now you figured out what you want real estate to do for you. So the next step is to try to look at what markets can deliver those results, right? So if you're, what markets have a price point, if you were looking for cash flow, what markets have a price point that you can get in with a reasonable down payment and with loan terms that we can get today, and is going to give you a solid cash flow. What markets have more, renter base to be able to deliver those rental results, right? Where does it work to buy that you can, with reasonable terms, buy and cash flow property? Yeah, you can cash flow property in any market with enough down, right? But that's not the point. So you want to find where you can put a reasonable investment in, you can create some cash flow, and then there you go. If you're looking at building equity, what markets are poised to have great equity growth, or what markets are, if you're not looking at future growth, you can force equity, right? So in more expensive markets, you can create more equity more quickly by finding properties that you can force equity, either by development, or by increasing the efficiency of how like an apartment building or a commercial building is run. You'd reduce the expenses, increase the income, all of that stuff. Even if you're just doing a fix and flip, the higher priced markets are going to give you more equity more quickly. So, and that's a very generalized statement, but that's very. I mean, you think about how many properties do you have to flip in a market where your average property is $150,000 versus a market where your average property is $500,000. You're probably going to be able to make more money more quickly in a more expensive market. So, where can you build that appreciation more quickly if that is your goal to do that? In a really big point here that I want to make is that even you want to look at a market as a whole, but you have to look within submarkets as well. So we're in the Portland, Oregon metro here, and we were talking at our investment group last night, and I brought up a bunch of numbers with rent growth for the Portland metro area, and the average was it's like 15% give or take over the last 12 months. Which is a big number. Not as big as some markets, probably better than some others, right? But within that, that's the market as a whole. Within that, there is like one section, and if you're not familiar with Portland, it's fine, but it's basically west of the city, where there's some major employers and just a ton of growth out in this one area, and they saw, more like 20% rent growth, and then there are other pockets that saw 3 to 4% rent growth. Huge difference. And there was even one pocket that was very, very minimally, but it was negative rent growth. And so you can't just say, oh, I'm going to invest in this metro area, and here's what the numbers are. You have to dig deeper than that and figure out what submarkets are performing really, really well, and are likely to continue to perform that way. So a metro area is huge. A metro area, again, it's just like looking at national data. It applies only to a certain degree because it's an average, right? And whenever you have an average, you've got things that are way above it and things that are way below it, and so you got to find where those things are and figure that out. And so dig deeper into the submarkets and not just the overall metro area. Okay, now now figured out a few markets that are going to work for your strategy. Dig in, figure out some submarkets, what ones are performing in a way that's going to help you achieve your goals and implement your strategy and all that stuff. We found those. So now you want to dig deeper into those markets. You want to look and see what is going on in those markets, what is causing this to function in this way, and what's the likelihood that this is going to continue. So there are absolutely markets that over the last couple of years just got really hot, just overly hot, and that the fundamentals weren't there. So you look back and, oh my goodness, this market grew by 30% appreciation in 1 year. That's crazy, right? Okay, well, that is crazy. That's so much equity, by the way, in 1 year. But so don't expect that. If that's your expectation moving forward, you need to adjust your expectation. That's not normal growth. But there are some markets where maybe there's data, there's things going on in that market that actually substantiate that, and there's a reason behind it. And there could be other markets that had that same amount of growth that it's temporary, or there's really no drivers behind that. Maybe a lot of people are moving there, but there's not a lot of jobs being created and things like that, right? So you have to look closer and not just draw a conclusion just from one thing, right? You have to dig in what's going on in the market and what is it likely to continue in a way that is going to help you reach your goals in investing. So things to look at. If it's a cash flow market, is it going to continue to be a cash flow market? And actually, it might not even be a bad thing if it's not, right? Maybe it will turn it. So Dallas is an example of this, where it used to be considered a cash flow market, and now it's kind of transitioned into, you can still get some good cash flow there, but it's kind of shifted more into an equity market. And that might be great. You might be able to get cash flow for a long time and then have it build equity as well, right? If that's your strategy. But dig into the drivers of the market. So what are the trends? What's driving the economy there? What kind of employment is being created? Is it being created, or are businesses coming in and moving into the area, being started, or are businesses leaving? What kind of jobs are being created? What are the income levels of those jobs? Are they jobs that can sustain the economy, or are they secondary jobs that need another employer to really drive that and continue those things forward? What does net migration look like? Are people moving there? Are people moving there, and what are the reasons they're moving there? Are they moving there because there's jobs being created? Are they moving there just to get away from a political situation temporarily? I mean, that happened a lot over the last couple of years. People moved out of areas because they didn't like what was going on in local politics, and a lot of them ended up in similar areas, and that drove a lot of growth in those markets. But there was really not a lot behind that other than just a lot of people moving there. So that's the kind of stuff you have to look at. What's causing the growth, and is there employment base and all of those other things there to sustain that growth? So another thing to look at with income, what is the income versus the current price point and rents and things like that. So you want to look at affordability, right? So if you're looking to have equity growth, and really with rents as well, rent growth, you need to really look at this too, because people can only afford to pay so much of their monthly income, right? So interest rates don't affect renters as much, right? But they do absolutely affect people that can buy, and which affects the market value of properties, because if the less people that are going to buy, the less competition, then the prices are going to level off. So there are markets where even with the higher interest rates that we have now, there are some markets that if you look at the income and you look at the average home price and the average salary, and median is what I should be saying, median salary, median home price, and the interest rates have affected it dramatically to where it's basically become unaffordable, or prices have to come down, or it doesn't work for the median income and the median price home with the new interest rates. But there are other markets where we haven't seen that yet. There's great jobs in the area, high paying jobs, and prices have not quite gotten to the point yet where it's considered unaffordable. They can still afford it, and they can, even at the new interest rates. And so that's the kind of stuff you have to look at, because there might still be room for growth in some of those markets. Even if interest rates do stay where they're at now, they can continue to grow because the local market, the jobs support it, the income support it. So that's a big one to look at, in my opinion, is income levels, and then where are they going? What's coming into the area? Are higher paying jobs coming into the area? Because all of that is going to play a part in whether or not it can sustain price growth and rent growth. Another big thing to look at is look at the laws and the political environment in that local market that you are considering to look at. Look at the state, and then look at your local jurisdictions. What are they? How do they feel about landlords? What is their demeanor and their feelings towards landlords? Do they see landlords as providing a service and as an ally in housing, or do they see landlords as being greedy capitalists and that they shouldn't even own property, and that the tenants should have all the rights? And there's a huge variety there, and you have to see, and I'm not saying don't invest in a market that has a more tenant friendly market, like the politics lean more towards the tenant, but just you have to know that going into it, and know what kind of challenges you're going to face in those markets. And there's markets where the tenants have a lot more rights than the person that owns the building. And then there's markets where the owners of the property, the landlords, basically have all the rights. So I personally think there should be a balance. I mean, your tenants need to have rights. You're giving them the right to use the property. They should have rights, and some of those rights need to be protected. But there needs to be a balance to make it an equal exchange for the risk and for the fact that you're providing housing to the market. So you need to look at that, make sure that you know what you're getting into, make sure that you're willing to take on that risk if it is more tenant friendly versus landlord friendly, or find an environment in a market where it's more favored towards the landlord and where they're business friendly and that sort of thing. So a lot of people don't look at that. It's really important to look at both business, how they feel about business, and are they business friendly, and also are they your landlord tenant law, and are they in favor of landlords, or are they more leaning towards tenant rights? And then look at the trends too. You don't just look at what's there currently. Look at where are they headed? Where have they been? Where are they headed? What is the current administration in that area? How do they feel about it? Is there anything on the agenda to change that, to get an idea of where things might be headed? Because just because it's a certain way right now doesn't mean it's going to stay that way. And all of this stuff, we're making a judgment call on a lot of this, right? You're not going to. We're making the best investment we can with the information that we can find. So don't be afraid to make a decision and be wrong. That's part of the deal. That's part of investing. We make decisions that are not 100% accurate sometimes, but it's better to get in and be a little bit wrong than to not make a decision and just not invest, right? You can pick a market and be like, oh shoot, I should have invested in this market instead. I could have made twice as much money in the same amount of time. Well, okay, but at least you invested, and at least you made the money in the market you were in. Don't live in the past. Don't live in regret. You're making the decision based on the information you have. It's really easy to look back and make a decision in hindsight, but you don't know that information at the time, and you're just making the best decision that you can. A couple other tips to look at when you're looking at markets and picking. Follow the money. So where are the big players investing? Where are big businesses expanding to? Where are local and the national governments investing in for infrastructure and things like that? Where is the money being invested? Because if the big players are investing there, chances are that area is going to do well. If big companies are investing in an area because they do research, they spend millions of dollars on analyzing markets and all of these things and seeing where things are headed so that they can be ahead of the curve and put their Walmarts and their Home Depots and your big box stores and all that where the trends are moving towards. They want to be ahead of that curve. So if you can pay attention to what some of the big players are doing, some of the big investors, you can kind of ride the coattails of what they're doing, and just know that they're doing a lot of research. Why not benefit from their research that they're doing? They're making calls. They're probably making a decision based on some pretty valid information, right? So that's a really big one. Pay attention to what's going in for infrastructure, where money is being invested, and what companies are moving to what areas. Where is growth constrained? So this could either be like geographical, like a physical barrier, like rivers and mountains and national forests, things like that, or it can be like political, like zoning, difficulties with development. It's just really hard to develop in an area. Lots of red tape, things like that. Whenever supply gets constrained, typically you're going to see more price growth in those areas, because as long as net migration is happening there in a positive way, and people are moving to that area and all the other factors are there, just having a constrained growth environment is not going to by itself create growth in price. But if you have all the other factors there, and then it's really difficult to expand your housing supply, you're going to see prices go up, because that supply is used to just basic supply and demand, right? You got lots of people wanting to buy and move in, and lots of reasons to buy, and you have a supply that is not getting to the market as quickly as it needs to for whatever reason, or it can't, or you just can't build anymore, that's going to have upward pressure on pricing. So that's a really good thing to look at as well. And then look at inventory levels and currently and what's in the pipeline, because there's some markets where inventory is really low, but over the next couple of years, if you look at what's being created, there are 30 to 40% of current inventory being added to the inventory over the next 12, 18, 24 months. That's a lot of new inventory coming on in a market. So, that would scare me a little bit. It's unless there was fundamentals behind it saying that yes, this many people are moving here. There's people moving to account for, and there can be some investment in there too. But you don't want it to be all investors, right, and speculative and everything. But if there's the drivers behind it and people are moving there and there's a use for those and they're going to be absorbed, then that's fine. But you have to look at that. It's another thing to look at. Is it going to be oversupplied essentially, right? Is the inventory level fine now, but in 2 years, all of a sudden we're going to have this glut of housing on, in the market, and now that's going to have, a downward pressure on pricing because there's going to be too much supply. So that's a huge one to look at as well. How much is being added to the market, and can the market absorb it? Not just what is it, the inventory level right now. So that is what I've got for you today, everyone. I hope that is helpful as you're looking at markets and in this kind of this shifting market that we're in with interest rates and with everything going on in the economy. It is still a really good time to invest because, as they say, the best time to buy real estate was 10 years ago. The second best time to buy it is now. Just be smart about it. Pick your markets wisely. Look at all these things. Start with your goals. What do you want investing to do for you? Look at what markets can deliver the results that you're looking for. Dig deeper into analyzing those markets, and then follow the money, follow the infrastructure. Look at where the trends are going, and you will be able to find a market that's going to work really well for you. So thanks again for listening in. We have a couple great podcast guests coming up here soon. I've been doing a lot of these monologue episodes, so hopefully they've been interesting, and thanks for sticking with me. Definitely planning on getting a lot more podcast guests on here for some interviews, getting back to doing that and talking to people that have found a way to implement investing in their busy lives and make it happen, and inspire everybody to go out and do the same thing. We can learn from them and their experiences and get inspired to do the same thing. So until next time, thanks again for listening, and make it a great rest of the day.